Good morning, my dear student. Today we are going to discuss about derivatives. Derivative is a important instrument, or we can call it as a financial instrument, which is available in the market to manage financial risk, right? So before we go into details about derivatives, I like to explain you about a risk. People always feels that risk means losing money, right? People always feels that risk means losing money. It's not that. Anything which is uncertainty or volatile in nature of cash flow is called a risk. For example, a person who has invested in a mutual fund or a person who has invested in a stock market where he is not getting a consistent return, right? For example, 1 year he is getting 50% return, another year he is getting minus 5% return, third year he is getting a 4% return, fifth year he is getting a 12% return, right? There is no consistency in the returns which the market has generated. That itself is called as a risk, right? And risk is nothing but is a volatile in cash flow or uncertainty on the event which is going to happen, which leads to a financial loss, right? So risk is not only losing money, it is also inconsistent in terms of receipt of cash flow, right? So what we are going to discuss about is the derivative is a financial instrument. How do we manage this risk, right? How do we mitigate this risk? Okay, right. So derivative is nothing but derived from underlying asset. Derivative is nothing but derived from underlying asset. Underlying asset can be anything, right? For example, you have a equity is there, that is underlying asset. Commodity is there, and interest rate is there, and the currency is there. These are all the underlying asset, right? It is derived from underlying asset. Please remember, derivative is a contract, not a product. It's a contract between two parties. Even one depth, I can go ahead and say that it is a legally binded contract between two parties, right? To buy or sell of financial securities at predetermined rate, comma, predetermined quantity and predetermined date, right? Basically, the contract between two parties to buy or sell services or a goods or a financial instrument at a future date on a specified quantity at a specified price, right? Suppose an example, I just want to buy a house after 3 months, right, at a 20 lakhs rupees. Here, the house is underlying asset. After 3 months is a predetermined rate, right? It's the one house I'm going to buy, it is a quantity, and 20 lakhs is a price which I'm fixed today, right? Derivative, it is nothing but a contract which will help two parties to fix the price today itself, right? So that is the reason I say it's a legally binded contract between two parties to buy or sell of an underlying asset at a predetermined rate, comma, predetermined quantity and predetermined price, right? Suppose I fix a price today at 20 lakhs to buy a house after 3 months, right? After 3 months, the price of the property goes up by 22 lakhs, right? From 20 lakhs to 22 lakhs. So what will happen? I still buy at 20 lakhs. The other party will sell at 20 lakhs only because I fixed the price to 3 months before, right? So I gain by 2 lakhs, right? In other way, or the alternate scenario, for example, on the same place there are a tsunami or any other events which has happened, which leads to the reduction in price of the property. On that particular property, prices comes down to 18 lakhs after 3 months. Still I will buy at 20 lakhs. I cannot say the price has gone down, I can pay only 18 lakhs, right? So here the parties, who is a buyer and seller, both fix the price 3 months before to execute the contract after 3 months, right? So whatever the price prevailing on the particular day, it is immaterial because the price is already fixed. If the prices goes up, the buyer of a contract gain. If the prices goes down, the the seller also gains that. The reason is, the price goes up, I still end up in paying the price which is agreed earlier, right? The price goes down, the seller will sell the property agreed on 3 months before, right? Basically is a contract which will help us to fix the price today. So there is no uncertainty on the prices which we are going to execute after 3 months, right? So derivative is a contract which will help us to fix a price at today for future transaction, right? This kind of a transaction, if it is not traded in the market, we call it as a forward market or a forward rate contract, right? We call it as is a the first derivative which is evolved in the market is called forward contract, right? Here this contract has got certain disadvantage. What is it? For example, I am planning to buy at 20 lakhs. After 3 months the rate goes up to 22 lakhs. What will happen? The other party or a seller which denies that, okay, the price has gone up, I don't want to sell you because I'm losing 2 lakhs rupees, right? So that we call it as it is a counterparty risk. That means the counterparty is not interested to execute the contract at the price which has been agreed earlier, right? The same way, if the prices goes down from 20 lakhs to 15 lakhs, the buyer may not be interested to buy at 20 lakhs still. The reason is he says the price has gone down, so I cannot buy it at 20 lakhs, right? That is a problem for the seller to sell it at 15 lakhs because he was agreed to sell at 20 lakhs. Now the price has gone down. The buyer is not willing to buy that, right? In the process, what is happening at there is a risk attached to that. There is a both the parties can violate the agreement which has been defined on the contract. So to mitigate this risk, what the financial market has evolved is the same forward contract traded in the market, right? Traded in the market because when you have started trading the market, you can take the margin for the contract, right? That we call it as a initial margin in the future market. When the forward contract is traded in the market, it is called the future, right? Same characteristics, the same features which is attached to the features. The only thing is it is traded in the market, it is called future. If it is not traded in the market, it is called forward. Forward is a over the counter contract, future is a exchange traded contract. Future has got an advantage where the counterparty risk is mitigated. Here both the parties cannot say we cannot buy, we cannot sell. Once a contract is executed, it is the obligation of the parties to execute the contract, right? Because the exchange or clearinghouse corporation of India Limited, we call it a CCIL, to ensure that the contract is executed. The future is nothing but the same forward contract where it is a contract between two parties to buy or sell of an underlying asset at a predetermined rate, at a predetermined quantity, at a predetermined date, right? The future is an exchange traded contract. There is no counterparty risk is there. There is a initial margin, there is a maintenance margin which is maintained in the system, and it is managed by the brokers and defined by the exchange, right? So the margin requirement is purely depends on volatility of the underlying asset. If the market is more volatile, the margin requirement is higher, right? Here the contracts are mark to margin, mark to market. What is mean by mark to market? We call it as MTM, right? Valuing the securities at the current market price. So every day you know what is the losses, what is the profit which you are make on the future contract, right? So the point which I'm trying to explain is derivative is nothing but underlying, derived from underlying asset. It is a contract between two parties to buy or sell of an underlying asset at predetermined rate, quantity and date. Okay, so this derivative is predominantly used for mitigating or managing the risk. You cannot nullify the risk at any point of time. Please remember, zero risk, zero return. High risk, high return. But it is not necessarily always you take a high risk and you can make high returns. There are times you take very high risk, but you may you may end up in losing all the money which you invested in the market, right? So I am redefining that entire point. When I say high risk high return, not only high risk high return, you can also add one more element to the definition: high risk high return, high capital requirement, right? When you are investing in a project, if the risk is high, you need to prepare to infuse more capital into that, right? So derivative is a product which will help you to manage risk, right? There are three type of trader in the market, right? One is edger, right? The people will edge the portfolio with the help of derivative. They call it as edger, or it's a process of managing the risk by the edger. It's called edging. It's a technique which will help to minimize the risk. Something like where you have a portfolio, you add derivatives into the portfolio which will reduce the risk of the particular portfolio. It is called edging. It's a process to minimize the risk of the portfolio. You cannot make it zero, right? The risk you cannot make it zero, right? If you make it zero, the return also zero, right? You need to have a element of risk. The quantum of risk which you are taking it will have a proportionate return which you can generate it. Coming back to the next type of investor, we call it as a speculator. The speculator is basically investor, or I can say a person who invest or put his money in the derivatives market to only make profit, right? Here is no risk management system, right? Here is just buying and selling of futures without having the underlying asset, is called a speculator. The third person is arbitrager. Arbitrager is nothing but a person who is buying and selling of underlying asset, or buying and selling of the instrument in a two different market simultaneously to make the price difference as a profit, right? For example, a person who trade in the foreign currency, right, he always work in a two market, right? There are times there are multiple market open in a similar time. For example, all Asian market like Singapore, Hong Kong, China, Malaysia, India, all these Asian market open between around 10 to 1 o'clock or 10 to 12 o'clock, all the market open simultaneously. During this period, what will happen is the person who buys a currency in a Singapore market and he found he can have a better price in Indian market, he can sell it immediately, so that he can take the price advantage, buying and selling of asset in a two different market simultaneously to make a profit out of that. Those persons are called arbitrager. So derivative has been used by hedgers, speculators, and arbitrager, right? This will help us to minimize the risk. Derivative has got a lot of products like futures, options, swaps, warrants, leaves. There are various derivative instruments which is available, where you can use these derivatives based on the complexity of the financial instrument which you are dealing it, and you can make money out of that, right? Or you can minimize the risk, right? It's one of the fantastic instrument, derivative, and but we need to use it as very very carefully, right? Otherwise what will happen is, if you are using derivatives in a wrong methodology, or without knowing that, you'll end up in losing a lot of money. That's why always we say that derivative is a double-edged sword, right? You can make it as a big money using derivatives, or you can lose entire money, right? And also please remember, derivative is a zero sum game. Zero sum game. One person profit is equal to other person losses, right? If you wanted to make money using derivatives, one person has to lose money for you to make profit, right? So whether you wanted to be a part of the gainers or part of the losers, it is all depends on how well you can manage derivative. Derivative is not a simple contract, it is a complex contract which one should understand, then only invest or use the derivatives in the market. Otherwise, it's my experience, it is very very risky instrument for managing the risk. So you need to see that how to make use of derivatives to manage your risk, right? So thank you so much, and we will give you more videos about various financial instruments which is available in the market, and how do we use this derivative instrument for mitigating the risk of that investments, right? So thank you so much, and those who are not subscribed our channel, please subscribe that. Thank you so much. We'll catch up again. Thank you.